So let's start diving into some live trading examples, looking at our high probability TCT models, mainly via the lens of B1 till B4. Meaning B1 is going to be our high probability ranging environments, which is established via a return to zone. B2 is going to be that minimum range duration. B3, quality third tap POY selection. And B4, quality breakout structure. Now, each and every individual trade also has its own individual characteristics, because when we're looking at distributions, some models might be a regular distribution model, some might offer TCT and TCT, some distribution models might be extended models, which obviously in the examples that I've chosen, there's lots of variety in what the model can develop into, but that's something you guys already know. We're going to be diving into it and then mainly referring back to B1 and B4 while pointing out some pretty advanced details in between that you can pick up as well, which is like these details you only see in the individual model itself. Okay, so what we can see right here is an example on Litecoin. Okay, so we're seeing this ranging environment on Litecoin where right here we have market structure trending up, right there, making a higher low and a higher high. And then we actually take that low right there before reversing back towards the upside. Now, probably on a higher time frame, this is simply going to be one low and one high and one higher low for the higher high. And it actually looks like that this right here has its own little TCT distribution model, with its own TCT in TCT actually right there on that third tap, as you can see, the 1, 2, and the 3. But the purpose of that was to go over into this bigger, more established range right here, where we can clearly see a initial range high, initial range low, and then a deviation 1, and then the third tap right there, which we're going to be diving into. But it's just that regular example where you can get that low time frame distribution model creating that fake breaker structure to go back up to create that mid time frame range, right? Now, what we can see right here, looking at our return to zone. Overall, the return to zone is fairly decent. Initially speaking, coming into that second tap, you can see that beautiful overall liquidity curve that was getting created right there with all these lows building up. You can see a low, higher low, higher low, higher low, higher low. I would say these are mainly primary higher lows, and you don't have that many internal higher lows backing you up as well. But there isn't any demand. So when you have all these primary lows stacking up and there's no demand, that still counts as good looking liquidity. And then price kind of came down here before going back up for the third tap, where we took out these two primary lows, but we also established some new lows right here with a low right there and a low right there. So overall, we can draw that liquidity curve right here where there's simply not really any demand and we just have lows backing us up. Besides that, we have a very established range here, because a range is either that slow grinding up price action creating a liquidity curve, or it's mainly just sideways price action. And we can clearly see here that this is a great example where a range has proper sideways price action, because you can see price is spending a lot of time in here within this range going sideways, hanging around that equilibrium of the range. Okay, so overall, we have a very good ranging environment here, building primary lows below, which is good for that potential TCT distribution model. Now, looking at our range duration, so far, when we're going to be identifying third tap and we're going to be looking at that breaker structure, we can see right here that this is our starting point of the range, okay? This is where that third tap confirmation will be taking place. The time spent in between that range starting point and that third tap confirmation is already going to be around 2 days and 12 hours and 50 minutes, which well exceeds that minimum duration of 1 day minimum. So we're in this ranging environment where we have a high probability ranging environment due to the actual proper range and the liquidity getting built below, while also having meeting the requirements of the minimum range duration, indicating that we're not trading a irrelevant model. Now we need to be looking at the third tap POY selection. So what we're kind of seeing here is that if we zoom out on the higher time frame, right? And we establish, okay, do we got some obvious supply there? Do we got some obvious liquidity? You can't really see the supply in the 1 hour. And on the 1 hour, you basically have like a lower high for a lower low right here. So that first lower high for the lower low on the 1 hour is going to be that high right there, which is underneath tab 1, okay? It's underneath tab 1. Going on the 45 minute, I'm simply going down in the time frame to just see what price action has to offer. You don't want to be skipping time frames. You want to be skimming down, not skipping any of these time frames. So I'm not seeing anything on the 45. I'm going on the 30. I'm not seeing anything on the 30. I'm going to the 15. And on the 15 minute right here, I can see a 50 minute lower high for the lower low starting right there. If I have to prioritize one lower high over the other, I'm obviously going to be prioritizing the one where price would have to be at or deviate tab 1 of the original starting point of the range right there. So I will be prioritizing that 15-minute lower high for the lower low, because in order for price to get to that point, we will be deviating tab 1, which is obviously going to be extra high probability. And I'm just simply going to be zooming in here on a lower time frame to see if there's anything in this region which stands out. Not seeing anything on the 10, nothing new, same lower high for the lower low. Not seeing anything on the 5, that remains the same lower high for the lower low. Going down to the 3 minute right here. And on the 3 minute, we actually see some interesting price action. So on the 3 minute, we can actually see that we have a high, we have a low, and we have a lower high for a lower low. Where in that pivot point of that lower high for the lower low, we actually create this 3 minute supply POI. Right there. This 3 minute order block with a very tiny inefficiency. But you can see that inefficiency still right here between this low and that high. That's still going to be your inefficiency, validating this as your 3 minute block. Okay. So we also, above that 15-minute lower high, have some supply, which could be a reason for price to come back up again. And I'm telling you now, guys, it is always better if you have your extreme supply POI above your extreme liquidity POI in case of that distribution. Because then you can sweep the liquidity coming into the supply. If you have supply with liquidity above, there could be a chance your supply gets disrespected because price has a reason to come higher, which is to grab the liquidity. If the liquidity is below the supply, that will not be the case. Now, you can also argue, maybe, potentially, that this is the 3 minute lower high for the lower low. So this could maybe be your extreme liquidity right there. However, there are two rules you need to apply here based from an expectational standpoint, whether price needs to come for this for you to validate your third tap or not. First, in order to grab the 15-minute lower high right there, you are already deviating tab 1. So getting a more refined level, in this case from a liquidity perspective, is not going to be a requirement because you're already deviating tab 1 once sweeping the 15-minute lower high. Second, if we go on an even lower time frame like the 1 minute right here, we can realize that this high isn't a liquidity high. Why? Because this high grabbed the lower high to the left. So this high grabbed liquidity on the left and expanded away, creating that supply POI, and is therefore not a liquidity high. And then especially when you come back for it and you front run that POI while creating these three kind of like triple highs right above it, making for a nice liquidity target, the expectation should be to sweep this and then dump lower and not go for this high right there. Because and it's not a liquidity high because the high grabbed liquidity and created supply in the process, but also because in order to already sweep this 15-minute lower high, price is already deviating tab 1. Now, we can see here that price relatively expanded a bit more aggressive within that third tap and then created a TCT in TCT model right there. Beautiful, low time frame, high probability range creation rejecting off that supply, and guess what? It ended up coming back for that high, right? Did it need to? No. Did it do it? Yes. Does it matter? No, because you're already looking at this from a potential TCT and TCT perspective, and you're just waiting for your confirmation. If in between that situation where you're waiting for your confirmation, you get the sweep, that's fine. If you don't get the sweep, that should not hold you back, right? And then right here, we actually entered on. These are all trades, guys, by the way, for my personal journal. So these are trades we have taken in a live trading environment. Right there, the moment you came up, broke that structure, bounce off demand, reverse that candle right here. That's where we shorted, right there. And then we put that stop loss above that high right there as our low time frame TCT invalidation, because what we can see right here is that price has a Model 1 distribution schematic right there that went over in a Model 2 as well by grabbing it high once more before going lower. Then right here, we did not use that immediate breaker structure because there was some demand below the price bounced off. And the moment that bounce started reversing back down, we went short on that low time frame TCT model, targeting this low here for a very high RR entry opportunity, which we even ran down further. And here, you can also see the perfect example, right? You can see the perfect example right here where coming into that third tap right there, you can see that price has a relatively more aggressive expansion coming into the level, okay? Where you created structure demand that pushed price into the third tap POY. This does not invalidate that return to zone. In this case, you actually had a local accumulation model right here that created the third tap of the distribution. This is a situation which can cause certain exceptions that we will talking about in section C of the mentorship, but I can already tell you right now, as a quick spoiler alert, that when you create your accumulation that pushes price into the third tap of the distribution, the purpose of this move up is to fill the shorts, and therefore this demand is not going to be protected by market makers protecting the positions entered here. Now this was simply a buying trigger getting activated in order to fill all the shorts and trigger all that liquidity above. However, if we do get some aggressive moves like this into the third tap, I like to see an overall medium time frame topping formation as a whole, because a low time frame breaker structure is not going to be working in these events. You want to see some local range formations. Doesn't have to be TCT and TCT, but just local topping structures on a medium time frame with a convincing break, and not just a low time frame break, because right here you can see that low time frame break here on the lower time frame right there, this low time frame break ended up causing the mid time frame range, which is what price is very vulnerable to doing if you have a relatively bigger expansion into that third tap. But you can see that this push up, it does not invalidate the total return to zone. It's simply just manipulation. And in this situation, Bitcoin was becoming very bearish with a bearish PO3, which adds confluence to the expectation of this being a fake push up to create the distribution. So again, you'll get that experience, you'll get that feeling. Now I'm showing you the individual model, but in a live trading environment, we're monitoring Bitcoin and the entire context of the market. And the context of the market was to go lower. That was the bias, and therefore we were expecting this push up to be manipulative, and therefore this return to zone does not get invalidated by that final push. So great example here where we have the return to zone, we have our third tap POY, which is a quality third tap POY because we have a clean order block with an obvious lower high. We have the minimum range duration. Now, from the quality breaker structure perspective, initially, I was looking at this breaker structure right here. I don't know if it was a 5-minute or a 3-minute. There we go. 3-minute breaker structure, which right here had that 3-minute break, but it closed right there into this demand POY. Okay, it closed in this demand POI. So I wanted to see what this candle did. Overall, you do have a quality break because what can you see? You can see V-shaped market structure getting reversed right there. Okay, there isn't particularly any supply creation, but it's overall a fast move up and a fast move down. You're not creating a buy side liquidity curve above you. It's a consistent fast move down breaking structure. Now in this case, because we're trading on such a low time frame, we had a demand POI below, which I waited on um, to see that get lost or disrespected before entering, which is something we'll be diving into again also from an execution standpoint, which is I think section D. But price spiked up there, and the moment I saw this candle reverse, I viewed this spike as a final local liquidity grab of this high right here, truly showcasing that distributed behavior. And then when we saw that candle aggressively reverse, that's your indication of market makers pushing price lower, and that's where we went short. But overall, from a structure perspective, right there on the 3-minute time frame, you have a very easy structured move up, quality breaker structure, which is fast and aggressive, did not particularly create any supply, can't always be the case, but there was no buy side liquidity curve or any indication that price had to reverse back up there. Okay, so a decent quality breaker structure, which was fast and aggressive. But from a timing standpoint, it also happened on New York Open right there, where this is exactly where New York opens, pushes price lower, and getting confirmations on your New York Open of your model is always going to be extra confidence behind the break of structure, because if you get your confirmation of the break on the session open, it can be a pretty fast reversal towards the downside, which was also the case right here where New York opened and you can see price just got smacked down here by the market makers. So overall, high probability ranging environment due to the return to zone and the overall sideways price action. We had that minimum range duration from starting point right here till break of structure confirmation of 2 days and 12 hours and 45 minutes. We had our tab 1, or we had our tab 3 deviating tab 1 coming into our third tab POI, creating TCT and TCT in this case with a quality break, and it was an amazing trade. Next model right here is actually a model that I would have loved to take, but it happened on Sunday at like 4 in the morning, so I was not present behind the charts. However, what you can see right here is that we had a relatively more aggressive move into a resistance POI and got the rejection back down. Okay, so we were trending up coming into the resistance POI, and then we got the rejection back down, and we clearly started to develop a range in here where, because we are trending up coming into resistance, we can draw a range from top to bottom, and this is going to be our ranging environment. Now, when determining if we have a high probability ranging environment, we can clearly see here that even when we started the range, coming towards that second tap right there was just an absolutely amazing return to zone, while having a beautiful range inefficiency as well, where there's just no price action here in the discount section of the range. So this is a very, very, very high probability ranging environments where we don't only see the primary lows getting built up, even when we extend it towards our third tap right there, which we'll be diving into later. We can clearly see that we have all these primary lows building up to be higher lows, but also these local lows that are in between are all just candle lows that are higher than the previous candle, which is absolutely amazing. So we have that combination of primary lows and internal lows stacking up, while also having a beautiful range inefficiency where this is the valid range. You just have no price action in the discount section, allowing for very high probability TCT distribution models. So we're meeting that high probability ranging environment right here. Then looking at the time duration, right here, the starting point of the range until around that break of structure, you can see right here we're in that 1 day and 11-hour duration category, which is also what I elaborated on, where usually if you have that minimum of 1 day, you're around that 1 day and 10 hours as that sweet spot. Okay? But very, very high probability ranging environment due to the good looking return to zone and the ranging efficiency, while meeting the minimum range duration. Now let's establish a quality third tap POI. So I always like to zoom out right here to kind of see if we have some order blocks in that upper section. So I'm not really seeing anything here like on the 45-minute or on the 1 hour. So I'm simply skimming down the time frames, not skipping over an individual one. And right here, I can see a 30-minute block right there, which is located around that tab 1. Very nice. And then we can see also a 15-minute block right there, which is just above that tab 1 high. And then going on a lower time frame, that 15-minute block is also a 10-minute block right there, which is basically the same. And then nothing really on the 5. Now I can go on a lower time frame here just to also see what do these blocks look like on a lower time frame. Like, do we actually have also a valid inefficiency on the lower time frame right here to establish a high probability supply POI when looking at the supply POI itself. And right here on the 1 minute time frame, that 30-minute block is the bigger red box here. And you can see that that 30-minute block also has that inefficiency right there. While at the same time, simultaneously, that 15-minute block also has valid low time frame structure supply with that inefficiency right there. So you can see that both POIs are also validated on the lower time frame as inefficiencies, while overall seeing kind of like a model 1 distribution that created the second tap of the higher time frame distribution model. We can kind of see this model 1 distribution. So I would say this is overall a very high probability supply POI because it's a combination of being that market maker supply of that second tap distribution, while also having valid low time frame structure supply or low time frame true inefficiencies backing up the higher time frame block. So very high probability supply POIs purely looking at the block itself. And from a location standpoint, well, both are around tab 1, right? Both of the blocks are located around tab 1. However, from a preference standpoint, the block that we will prioritize and prefer is going to be the 15-minute block. Both are around tab 1, but in best case scenarios, we're going to be wanting a deviation of tab 1. Where if you deviate to tab 1 and you come for the 15-minute block, there's going to be no room of error because there's no reason to go back above that high that you put in after breaking market structure back to bearish because there is no supply located higher. If we mitigate the 30-minute block and we don't mitigate the 15, there could be a chance that price might stop you out once more before actually reversing back down because it wanted to go for the 15-minute. Now, in the previous lecture, I told you guys that it's really context dependent. In some situations, I'm not going to be trading the 30-minute block mitigation. Where in some other situations, I will trade the 30-minute block mitigation if we get that bearish break of structure without tapping into the 15-minute one. And it all has to do with how high, in what type of high probability fashion is your model building up coming towards that tap. Is there a reason for price to put in a higher low for a higher high to then start that bounce, or is it just a beautiful return to zone with a range and efficiency? Which in this case right here, we have our tab 1, we have our tab 2, and this is just a beautiful high probability ranging environment where you can clearly see that inefficiency getting created, and we're already deviating that volume area high coming into that 30-minute block right there, where any break of structure back to bearish could also be a break back inside that volume profile while having a beautiful return to zone with a range and efficiency indicating a TWT model creation. So we're going to be zooming in here on a lower time frame to see if we had some high quality break of structure opportunities. So I'm going to the 5. Do I see a 5-minute higher low? So the 5-minute higher low is in here, but do we also have a lower time frame higher low that we can potentially use? Right here, we also have the 3-minute time frame right there. Now, you do have right here a 3-minute order block protecting price from coming towards that 5-minute low. But the moment you break that 3, you're closing so deep and aggressive within that block right there that that's already indicating and showcasing failure of the block itself. So then when you see price tap into there and reject, you can already start shorting in here because you're expecting the demand to fail because you're closing so deep in it. Usually when you have a fake break to go higher, you have like a tap in the upper section and go. If you start closing deep in it in such a high probability environment, you can already start shorting on that initial close deeper within the block. But right here, what do we see from a quality breaker structure perspective? Price is making higher lows and higher highs. What do we have? A fast and aggressive move towards the downside, having a great displacement candle below that market structure low, creating structure supply, which is protecting price from coming to your invalidation right there. Because we create a fair value gap on the break, validating this as structure supply. So while structure is getting broken, you are creating resistance, which is protecting price from coming to your invalidation. And therefore, this is a very high quality breaker structure. And therefore, also that combination of getting that high quality break can give you that extra confidence needed where you may initially still had that doubt of price potentially coming towards that more refined area up here. But the moment that you break that structure super aggressive, that's why I also said it depends on what price does. But when you break that market structure low in such an aggressive fashion that you're creating resistance that's protecting price from coming to your invalidation, that can give you the confidence needed to enter on that break right there, put the stop loss below the low, and then target way lower. Where in this case, you had that breaker structure, and the target would be the rotation back down to the range low. But you had that beautiful return to zone that you could draw almost straight into that market structure low. So you had two POIs right here. The preferred scenario would have been to mitigate that 15-minute block, but price came to the 30-minute block and got a very high quality breaker structure while being in a very high probability distributive environment due to the range inefficiency and the return to zone. And therefore you can still take this trade. Is there an opportunity that you might still get stopped out and price goes higher before you go lower? Yes, it's a probability game, right? But in this case, the probabilities are going to be in your favor to short. And if you get stopped out, then guess what? You may have to take a 1% loss before re-entering on a breaker structure back to bearish after mitigating the 15 that can allow for well over 10 RR win opportunities. So getting stopped out for 1 to make 10 is a trade and a bet that I would take every single time. But in this case, because of the high probability ranging environment, I want to showcase you an example where I am trading the 30-minute block as my third tap POI because of the high probability distributive environment in combination with that quality break that is creating supply and therefore protecting price from coming back above that high. Now, on Chill Guy right here, we have an easier example because we're focusing now on a Model 1 distribution. So right here, we're coming into an area of resistance on the left, was some sort of a wick supply. Not that important for our current focus with the high probability variables, but we can see here that price is simply making a high, making a high, making a low, making a higher high, right? Where we can clearly see some lows getting built in the process, lots of rangy behavior. We pull that range from high to low, and we can look for potential distribution models because we came into also an area of resistance. We have that initial range high, we have that initial range low, and then we get that deviation 1, and then you can see right here that price gets that second deviation, indicating a potential Model 1 distribution, right? Now, looking here at our B1, establishing a high probability ranging environment, you can see here that on the higher time frame, like the 30, we can draw a return to zone from this low to that low right there, where we can see all these primary lows getting built up with a low of the range low, higher low, higher low, higher low, higher low, and a higher low right there, and a higher low right there. So our primary lows are right here, where it may look like deviations on a higher time frame, but these lows right here are triple lows. So they're all very close to each other, but they don't take out the previous low. So you got like triple lows right here, your three lows all very close by, creating nice sell side liquidity in that region once price starts tapping into those levels. And that can allow for a very fast and quick flashy move down, which will indicate lots of liquidations. So we can see that return to zone up until there. And this is going to be an example where if I go on a lower time frame, it may look on the higher time frame like a more aggressive expansion right here, coming towards that final third tap. But if I go on a lower time frame, you can see that that is mainly just also liquidity on the lower time frame here. So on the higher time frame, it looks like a more aggressive move. On the lower time frame, you can see it's mainly just lows getting built up here, where you got your primary higher lows right there on the 1 minute with a higher low and a higher low and a higher low and a higher low. But then you can also see here all these internal lows getting built up, where you have all these candles lows, where each candle low is a higher low compared to the previous candle. So it's a perfect example of it may look like a more aggressive expansion on the higher time frame, and you can kind of draw that return to zone until this market structure low. But zooming in here on the lower time frame, you can see that that final push up is also mainly just liquidity, just only visible on the lower time frame. So that high quality return to zone is there. Now, looking at the time it took from the starting point of the range till around that third tap and breaker structure confirmation, we can see that it's around 2 days and 11 hours, therefore meeting the minimum range duration requirements. So we have a high probability ranging environment with a good looking return to zone. We're meeting the minimum range duration. The quality third tap POI is extremely simple because we're simply taking the second tap high, indicating a model 1 distribution. All that there's left is to look for a quality breaker structure. So zooming into this region right here, going on a lower time frame, and again guys, these are all trades that have been taken. My journal is right here. I'm picking them all out of my journal. You can see right here that we have a high, higher low, and a higher high, and look at this. A very fast and aggressive move down, creating great time displacement below that market structure low, therefore also creating a structure supply POI, which is protecting price from coming towards your invalidation. A perfect example of getting that quality breaker structure with that proper displacement below that creates that structure supply, which can deliver the lower high for the lower low, because that would be expectational order flow after the break. And therefore it's very, you can enter with lots of confidence on that break right here, on that break with your stop loss above that high right there. Now, when you have displacement candles, they're this aggressive, I usually tend to wait for a slow pullback. I don't always wait for the supply mitigation. I just wait for the pullback candle, and that's where I already start entering. I don't need the exact entry. The entry is already going to be extremely high RR. It's just very common for price to get a pullback candle after such a big displacement below. But right there, that's going to be your entry. Quality break, fast and aggressive, creating supply in the process. And price ended up making its way back down towards that range low. Now, you got some retests in the process right there, which is extremely fine. Price can retest his supply if it wants to. You just need to stick to the plan and let the trade play out right here. But when I'm showcasing you these models, I really want you to let these models resonate with you. I want you to look at the overall look of this model. The great time displacement between the taps as just an extra benefit, the quality return to zone, the minimum range duration, the overall look of this model is just super clean. Sometimes I see you guys posting models and they just look extremely forced. When you look at this model, it's almost inevitable to not take it. At least it's like you cannot not see it. I think that's the best way for me to elaborate on what I'm trying to make clear. If you know what a Wyckoff Model 1 distribution looks like, you cannot unsee this. You look at the chart and you just immediately you see it and you have to take it. It's usually the models that are like barely visible on a normal time frame where you're really forcing your taps, adjusting it so it just meets the requirements potentially, that tend to not work. If you know about a Model 1 distribution and you go to a chart and you see this, you cannot not see it. It immediately jumps out. And those are always going to be the best place. But also a great example of getting that return to zone up until that point with that final more explosive phase, which on the lower time frame is still a return to zone.